Welcome back to the deep dive. Today we're going to try and cut through the complexity of something absolutely fundamental to every single business out there, revenue.
The top line.
Exactly, the top line. It's the lifeblood, right? It drives earnings, stock prices, everything.
Pretty much everything, yeah. Without it, a company doesn't really exist.
And because it's so critical, well, it's also, let's be honest, susceptible to manipulation or just misunderstanding.
Yeah.
So knowing how it really works is key.
Absolutely crucial.
So our deep dive today, it's all about revenue recognition. Specifically, we're looking at the Converged Global Standard, ASC 606. We want to give you a bit of a shortcut, really, to understanding how and when companies can, legitimately count that income. But before we dive deeper, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, examples, explanations, everything we discuss comes from the comprehensive accounting resources over at farhatlectures.com.
Great resources there.
Definitely. So whether you're an accounting student, maybe studying for the CPA exam, or already a professional, you should check out the website. They've got extra practice questions, video lectures, loads of detailed support to help reinforce what we talk about today. And a special thanks to Professor Farhat for providing this valuable material for our discussion.
Yeah, absolutely. And, speaking of this standardization you mentioned, ASC 606, it really is a huge leap forward.
How so? What was it like before?
Well, historically, here in the U.S., under GAAP, that's generally accepted accounting principles.
For a rule book.
Right, the rule book for U.S. companies. There were, believe it or not, well over 100 different standards just for recognizing revenue.
100? Wow.
Yeah, it was a real patchwork, often inconsistent. Meanwhile, you look globally, under IFRS, International Financial Reporting Standards,
Okay.
they basically had just one main standard. So you can imagine the headaches for investors trying to compare, say, a big American tech company to a European manufacturer.
Nightmare. Apples and oranges.
Yeah.
Completely.
Total nightmare. Made global comparisons incredibly difficult.
So how did the accounting world finally get its act together on this?
Well, recognizing that massive challenge, the two big standard-setting bodies, the FASB, the Financial Accounting Standards Board here in the U.S., and the IASB, the International Accounting Standards Board, globally, they actually joined forces.
Collaboration.
Exactly. The goal was clear: create a single, unified set of guidelines. And what came out of that was revenue from contracts with customers. We know it as ASC 606 in the U.S., and internationally, it's IFRS 15. Same core standard.
Okay, so what are the big wins from this convergence?
Oh, the benefits are huge. First, comparability. Massively improved. Not just across countries, but different industries, even between similar companies. Think comparing Sony's revenue approach to Adidas is much clearer now.
Right.
It also helps simplify preparing financial statements, and honestly, it just makes things clearer for anyone trying to understand a company's real financial performance.
So consistency, comparability, clarity. Makes sense. But what's the sort of the core thinking behind it? The philosophy, if you like. Because I hear it's not just about when the money comes in anymore.
You're absolutely right. That's a key shift. At its heart, the new standard uses what's called the asset liability approach.
Okay, asset liability. What does that mean in practice?
It's a fundamental change in perspective. Instead of focusing on this older, sometimes kind of fuzzy idea of the earnings process, revenue recognition now really hinges on how a contract changes a company's assets and liabilities.
Oh, the contract itself.
Yes. Think about assets like accounts receivable, that's your right to get paid, or liabilities like, say, an obligation to provide a service later.
Okay.
The standard forces companies to look closely at that contract and figure out the specific enforceable rights and obligations it creates. For both sides, it's less about is the work done, and more about has control of the good or service transferred according to the contract.
That does sound much more structured, more concrete.
It is.
So to actually do this, to put this approach into practice, the standard lays out a pretty clear 5-step model, right?
That's correct. A 5-step process.
Now, I know we're going to focus most of our energy today on step 1 because, well, you've convinced me it's the bedrock.
It really is.
But maybe let's just quickly walk through all 5 steps first, just to get the whole picture in mind.
Good idea. Let's use an example. Maybe a bit more modern than just selling a car. Let's say Nexus Tech Solutions. They're a software company.
Okay.
They make a deal, a contract, with a client for an enterprise AI integration package. Price tag, $500,000.
An enterprise AI integration package. Sounds fancy. What's in it?
Well, let's say it includes a few things. A perpetual software license, they get the software forever.
Right.
Custom implementation services, Nexus Tech helps set it up. And 1 year of premium support and updates. So, a bundle.
Got it. Software, setup, support, a $500,000 bundle. How do the 5 steps apply here?
Okay, so first, step 1. Identify the contract with customers.
Right. Is there a real agreement?
In this case, yeah. There's a formal written agreement between Nexus Tech and the client. Signed, sealed, spells out the terms. Clear contract exists. Without that, we stop.
Okay, checks box 1. What's next?
Step 2. Identify the separate performance obligations in the contract. This is where that bundle comes in.
Breaking it down.
Exactly. Nexus Tech isn't just selling one thing, they're promising distinct items. The software license is one obligation, the implementation service, that's another, and the year of support, that's a third.
So 3 separate promises, essentially.
Correct. Each one is a distinct performance obligation because the customer can benefit from each on its own or with other readily available resources.
Makes sense. Step 3.
Step 3. Determine the transaction price.
Okay, that seems easy here. $500,000.
Well, in this simple case, yes, $500,000. But it could get tricky. What if there were bonuses tied to how quickly Nexus Tech implements it? Or volume discounts? This step is about figuring out the total amount Nexus expects to actually get.
So nailing down the total compensation. Got it. Step 4.
Step 4. Allocate the transaction price to the separate performance obligations.
Right, splitting up the $500,000.
Precisely. That $500 isn't all recognized at once or all tied to one thing. Nexus Tech has to figure out how much of that total price relates to the software license, how much to the implementation, and how much to the support.
How do you do that?
Typically, based on those standalone selling prices, what would they charge for each of those things separately? That usually guides the allocation.
Okay, makes sense. Allocate the money based on individual value. And the final step.
Step 5. Recognize revenue when, or as, each performance obligation is satisfied.
So when the promises are kept.
Exactly. Nexus Tech would probably recognize revenue for the software license right when they hand over control of it, likely up front.
Yeah.
Revenue for the implementation services, that would likely be recognized over time as they actually do the setup work. And the support revenue. That gets recognized evenly over the 1-year support period. Each piece recognized as it's delivered or fulfilled.
Wow, okay. That 5-step model definitely provides a clear roadmap. Much needed, it sounds like.
It does bring structure.
But you mentioned, and I've heard this too, that step 1, just identifying the contract, can actually be surprisingly, maybe even deceptively complex sometimes.
Oh, absolutely. You're hitting on a really critical point.
Why is it so fundamental?
Because if you get step 1 wrong, if you don't correctly identify that a valid contract actually exists for revenue recognition purposes, then, well, everything else you do with the other steps is basically built on sand. It's flawed from the start.
Okay, so what defines a contract in this specific context? Is it just any agreement?
Not quite. Formally, under ASC 606, a contract is defined as an agreement between 2 or more parties that creates enforceable rights and obligations.
Enforceable, that sounds key.
It is, and critically, both parties have to actually approve the contract and committed to performing their respective obligations. You can't just have one side decide there's a contract. It needs mutual agreement and intent.
Right, makes perfect sense. So that leads to a question I think a lot of people have. Does it have to be a formal written document? Signed in ink? Because, we make agreements all the time without paperwork.
That's a fantastic question, and the answer is definitely no.
No.
Okay. While a written contract is often best practice, it provides clarity, legal backing, it's absolutely not required for revenue recognition under ASC 606.
So, what? Give me an example.
Think about your everyday life. You walk into a grocery store, pick items off the shelf, go to the self-checkout, and pay.
Right. No signatures involved.
Exactly. But is there a contract? Absolutely. It's an implied contract. Your actions selecting the goods, going to pay, imply your agreement to buy them, creating your obligation to pay, and the store's obligation to give you the goods.
Okay. Implied through actions. What about just talking? Can businesses make contracts verbally?
Yes. Oral contracts can be perfectly valid, too. Imagine, say, 2 used car dealerships who've worked together for years. One calls the other and says, hey, I need 3 sedans by Friday, usual terms. And the other says, yep, got you covered.
Based purely on trust and their history.
Right. If that agreement creates enforceable rights and obligations and meets the other criteria we'll talk about, it's a valid contract for revenue recognition, even though nothing was written down.
Interesting. Any other types?
Yeah, there are also what we call customary business practices.
Customary.
Think about a long-term supplier relationship. Maybe a supplier knows that whenever their client's inventory of a certain part drops below 50 units, they automatically ship a new batch. They don't need a new purchase order every single time.
It's just understood, baked into how they do business.
Exactly. The contract, the agreement, is implicit in that established custom. So the form doesn't matter so much, written, implied, oral, customary. What matters is that a foundational agreement must exist. No contract, no revenue under ASC 606. It's the starting point.
Okay, so the form isn't the main thing. It's the substance and enforceable agreement. But I also hear there are 5 more specific criteria that any contract, regardless of form, has to meet to be considered valid specifically for revenue recognition under ASC 606.
That's right. These are really important safeguards. Think of them as gatekeepers. They ensure the transaction is legitimate and substantial enough to actually warrant recognizing revenue in the financial statements.
Okay, gatekeepers. What's the first one?
First, the contract must have commercial substance.
Commercial substance, what does that mean?
It means the deal has to have a genuine business purpose. It needs to be expected to change the future cash flows, the amount, timing, or risk of both parties involved.
So it can't just be moving paper around.
Exactly. It's about preventing, phantom revenue. For example, Company A sells a building to Company B, but immediately agrees to lease it back for its entire useful life.
So nothing really changes economically for Company A.
Precisely. That transaction likely lacks commercial substance because Company A's economic position hasn't fundamentally changed. This criterion is really key for investor protection, making sure the revenue reported actually reflects real economic activity, not just financial engineering to boost the top line.
That makes a lot of sense. Protects the integrity of the numbers. What's the second gatekeeper?
Second, both parties must approve the contract and be committed to fulfilling their obligations.
Committed, so more than just signing.
Yes, it goes beyond just initial agreement. If, say, one party has a very easy, penalty-free way to just walk away from the deal, a termination clause without real consequence, then is there really a commitment? Probably not.
Right. No real skin in the game yet.
Exactly. If that commitment isn't truly there from both sides, it's not a solid enough foundation for recognizing revenue yet.
Okay. Commercial substance commitment. What's third?
Third, the company must be able to identify the payment terms, the consideration.
The price, basically.
Essentially, yes. The contract needs to clearly state how much is being paid, when, and how. Or at least, it needs to provide enough information so the company can reliably estimate the transaction price.
Does it have to be a fixed number up front?
No, not necessarily. Think back to our Nexus Tech example. What if that $500,000 price could change? Maybe the client gets a 10% discount if they successfully integrate the AI into 5 departments within 6 months.
Ah, so the price could vary. Variable consideration.
Exactly. Even with that variability, as long as the terms are clear enough to estimate what Nexus Tech realistically expects to receive, the payment terms are considered identifiable.
Got it. Identifiable payment terms. Fourth criterion.
Fourth, the contract must clearly identify the rights of each party regarding the goods or services to be transferred.
So what exactly is being bought and sold?
Precisely. What is the seller obligated to provide? What is the buyer entitled to receive in return for their payment? This needs to be spelled out clearly enough to understand the specific promises being made, those performance obligations we talked about earlier. No ambiguity.
Clear definition of what's being exchanged. Okay, makes sense. And the last one, number 5.
And finally, number 5, and this is a big one. It must be probable that the entity will collect the consideration to which it is entitled.
Probable collectability. So they actually expect to get paid?
Yes. This is fundamental. Let's say Nexus Tech signs that $500,000 contract, but they know the client is in serious financial trouble, maybe teetering on bankruptcy. Collection looks highly doubtful.
Right.
Well, from an accounting perspective under ASC 606, if collection isn't probable, you generally don't have a valid contract for revenue recognition purposes yet. Because recognizing revenue, you almost certainly won't collect. That misrepresents the company's financial reality.
So what happens then? If collection isn't probable, does Nexus Tech just, eat the potential cost of starting work?
That leads to an important exception, or maybe a different path. If collectability is considered susceptible, which basically means it's shaky, uncertain, maybe less than probable, but the company decides, you know what, we'll take the business risk anyway.
Okay, they take a gamble.
Right. In that situation, the guidance generally points towards using cash basis accounting for that specific contract.
Cash basis, meaning?
Meaning, Nexus Tech would only recognize the revenue when and if they actually receive the cash from the client. Not when they deliver the software or perform the service, but only when the money hits their bank account.
Okay. So revenue follows the cash in those risky situations.
Exactly. It really forces businesses to think hard about credit risk, doesn't it? How much risk are you willing to accept from a customer, and how will that decision flow through to your reported revenue?
It definitely does. So let's try and tie this together. What does this all mean for you, our listener? We've kind of unpacked why revenue is so vital, right? It's the financial heartbeat,
Absolutely.
and we saw this big global push to standardize how we recognize it with ASC 606.
A necessary push.
And the absolute foundation, the bedrock of this whole framework, is the concept of a contract.
Can't start without it.
But it's not just any piece of paper. It's an agreement creating those enforceable rights and obligations. And it has to pass those 5 gatekeeper tests we just walked through: commercial substance, commitment, identifiable payment, clear rights, and crucially, probable collectability.
Spot on. And really understanding this first step, identifying that valid contract, it isn't just, an academic exercise. It's vital.
Why vital?
Because it's the gateway. Everything else flows from it. Getting the performance obligations right, figuring out the transaction price, especially if it's variable. All that depends on having correctly identified a valid contract in the first place.
It sets the stage for everything that follows.
Precisely.
Okay, so here's something to maybe mull over after listening. Consider just how many contracts you enter into, maybe every single day, without giving it a second thought.
Like buying coffee.
Yeah, buying coffee, clicking I agree on a software update online.
Downloading an app.
Right. So thinking about the strict financial definition we just discussed, enforceable rights, obligations, commercial substance, collectability, what does that reveal? What does it tell us about the underlying layers of trust, enforceability, and economic reality that have to exist for pretty much every commercial interaction to happen, even the ones that seem incredibly simple on the surface?
It really does make you think about the structure beneath our everyday transactions.
Definitely something to ponder.